Every trader wants an edge. They want something that gives them an advantage in the market, a way to see what's coming next and catch the move before everyone else reacts. But now, thanks to the prediction markets like Kalshi, we can actually trade the future itself. Before Kalshi, we were stuck playing reaction games. We'd wait for the CPI to drop, or for Powell to speak, or for earnings to hit, and then we'd try to trade the ripple effect after the event. Stocks, crypto, everything we touched was just the echo of a headline. And that's the problem. When you trade in traditional markets, trying to trade the event directly, like earnings plays or FOMC week, is often a gamble. Too many variables, too much emotion, too much volatility, too much priced in noise. We're not in the business of gambling, we're in the business of managing risk. That's why we've always taught traders to trade the reaction to the reaction, the point where emotion cools, clarity returns, and probability is measurable again. That's how disciplined traders survive. But Kalshi changes that equation. It gives us a new lane. A place where you can trade the event itself without needing to predict how the crowd will react afterward. You're not guessing how the market feels about inflation. You're simply trading whether inflation is high or low. You're not trying to read Powell's tone or analyze sentiment. You're directly trading the outcome. Think about how many times you traded an earnings play and this happened. You buy a bullish position because you believe the company will post greater numbers, then earnings drop, they are great, and yet the stock tanks anyway. You are right on the data, but wrong on the reaction. Kalshi removes that layer of emotional chaos. It lets you trade the data itself, clean, binary, it's either yes or no. That's what makes prediction markets so powerful. They bridge the gap between risk management and speculation. Instead of chasing reactions, you can now position before the story unfolds, safely, transparently, and with probabilities you can actually measure. Because we all know how hard it is trying to figure out your risk to reward on options contracts with the Greeks and time decay. Kalshi doesn't have any of that. With Kalshi, we can trade the event itself, not the chart that follows it, not the market's emotional response to it, just the outcome. Will the Fed cut rates this meeting? Will inflation stay above 3.5%? Will oil end the month above $80? Each of those is an actual tradable question on Kalshi, a federally regulated exchange built for prediction markets. It's like trading information itself before the rest of the market prices it in. That's what we're diving into this video, how to use Kalshi as a professional tool for risk management and opportunity, not as a gambling app. We're going to talk about how to hedge your portfolio with it, how to combine it with your stock and crypto positions, and how to think like a macro strategist who trades cause instead of effects. So if you're someone who's been watching the market lately, seeing how unpredictable everything feels, how one speech or one CPI release can erase weeks of progress, this video is for you, because we're going to break down how we can stay ahead of the chaos using education, not emotion. Let's start with the big question. Why trade events at all? Why not just stick to charts, earnings, and coins? Because every stock, every coin, every market move you've ever watched was reacting to an event. CPI, unemployment, rate decisions, geopolitical tension, these are the invisible hands moving the visible charts. When you trade the chart, you're already late. When you trade the event, you're early. Think about this like weather versus thermometer. The thermometer tells you what already happened, the weather pattern tells you what's about to happen. Kalshi is the weather pattern. It lets you position before the market reads the temperature. For example, say we got a CPI release next week. On Kalshi, there might be a contract that says, will CPI next week be above 3.5%? Each yes or no contract trades between $0 and $1. Make sure to check out our prior video on Kalshi to understand how these contracts work. Now compare that to trading the S&P 500 or NASDAQ into CPI week. You might buy calls or hedge with puts, but that introduces theta decay, volatility shifts, and gamma exposure. You're not just betting on inflation data, you're betting on how the entire market feels about that data. That's layers of uncertainty stacked on top of each other. With Kalshi, you strip that noise out. You trade the data point itself. It's clean, binary, and focused. That's what I mean when I say, with Kalshi we can trade the event, not just the reaction. That's the first mental shift. Kalshi lets you isolate cause from effect. Instead of trading the emotional reaction of millions of investors, you trade the single data point that triggers them. Now let's talk about timing. Most traders operate in a delayed feedback loop. They react once information hits CNBC or X. But markets like Kalshi are information thermometers. Odds begin to shift before announcements because sophisticated traders are constantly repricing probability. For instance, before a Federal Reserve meeting, Kalshi's will the Fed raise rates this meeting contract might be sitting at 70 cents. If a surprise jobs report drops showing weakness, those odds can fall to 50 cents instantly. hours before the stock market opens. That data alone tells you what institutional expectations are doing in real time. Even if you never place a trade, Kalshi odds can serve as a sentiment indicator, like a probability-based VIX. And crypto markets, especially Bitcoin and Ethereum, are ultra sensitive to macro signals. When rate cut probabilities on Kalshi start climbing, Bitcoin might front run the move. Why? Because liquidity expectations rise. So even as a crypto trader, watching Kalshi can help you anticipate rotations before they hit your chart. Trading macro events instead of stocks or crypto gives you a cleaner, more precise way to express a view. Instead of guessing how markets feel about inflation, you can directly trade whether inflation is hot or not. Instead of predicting whether tech will sell off after Powell, you can trade whether Powell actually hikes. You're going from emotional reaction to informational precision. However, there are strategies that involve using Kalshi contracts alongside your stock or crypto portfolio. In other words, it's not just a standalone market, it's a hedging tool. Most traders only think of hedging in one way. They buy puts, they short something, or they move to cash. But that kind of hedging comes with its own problems, like options decay, shorts can squeeze, and cash gets devalued during inflation. Kalshi gives you a new way to hedge, one that's clean, direct, and event-based. Let's say you're long on tech. Maybe you've got positions in Apple, Nvidia, and a few high-growth ETFs. Those are all rate sensitive. If the Fed turns hawkish again, those stocks could drop fast. Instead of guessing when to sell, you could open a hedge on Kalshi through the "Will the Fed raise rates at the next meeting?" contract. Let's say the yes side of the contract is trading at 35 cents. You could buy $500 worth of yes contracts, essentially saying that if the Fed hikes, I'll profit on this. If they do hike, your contract settles at $1 and your $500 turns into $1,400. If they don't hike, you lose the $500, but your tech portfolio likely rises in value because the market loves rate pauses. Your stock portfolio size will determine how big your Kalshi position should be. One way to help determine this is to think in percentage risk terms rather than dollar amounts. Ask yourself, if this macro event goes against me, how much would my portfolio realistically lose? Then size your Kalshi hedge to offset a portion of the potential drawdown. For example, if a surprise rate hike might cause your $10,000 tech portfolio to drop 3%, that's a $300 downside. You could aim to buy roughly $300 worth of exposure in a related Kalshi market, like will the Fed raise rates this meeting, so that if the hike does occur, your Kalshi position gains close to what your stocks lose. It doesn't have to be a perfect one-to-one match. The goal isn't to eliminate risk entirely, it's to soften the impact of volatility. Think of it like putting on a seatbelt. It won't stop the crash, but it can keep you safe enough to stay in the game. Over time, you'll get a feel for how sensitive your holdings are to certain events, and that awareness helps you size smarter, hedge cleaner, and react less emotionally when the headlines hit. If your account is $1,000 or $100, you can do the math the same way. It works for all account sizes. That's what I mean by non-correlated hedging. You're using Kalshi to offset risk that traditional tools can't precisely match. It's not a directional hedge, it's an informational hedge. You're protecting yourself from data surprises. Now compare that to buying SPY puts ahead of the same event. You need to pick a strike, an expiration date, pay the implied volatility premium, and then deal with time decay. You're also at the mercy of the market's overreaction or underreaction to the Fed's tone. Kalshi, by contrast, is binary. This event happens or it doesn't. You're removing a whole layer of emotional noise. This is what pros mean when they talk about balancing asymmetry. You're not trying to be right every time. You're setting up positions where one side of the trade wins no matter which way the news breaks. And it's not just macro data. Kalshi has markets for oil prices, unemployment rates, GDP, election outcomes, and even Bitcoin milestones. For instance, will Bitcoin close above $100,000 this year can serve as a hedge or a speculative exposure, depending on how your portfolio is built. This approach is powerful because it builds on what you already know as a trader, understanding catalysts and probabilities, and converts that knowledge into structured protection. You start to realize something. Kalshi is essentially a macro insurance exchange. It lets you insure against the unknowns, rate changes, inflation shocks, policy surprises, that wrecks unprotected portfolios. And the best part, there's no need to guess how stocks or coins will react. You just decide if the event happens or not. No Greeks, no time decay. Now let's talk about one of the biggest advantages of using Kalshi this way: cost efficiency. If you wanted to hedge a $10,000 stock portfolio using options, you might spend anywhere from $300 to $800 in premiums for 1 month's protection, and that covers decays daily. Kalshi, on the other hand, lets you target a specific event with minimal cost. You could allocate $200 to $500 to event contracts that last a few weeks, and they don't decay with time in the same way. They only move when probabilities change. For example, if Powell gives a speech hinting that the Fed might pause, then the rate hike contracts could drop from 40 cents to 25 cents overnight, and your hedge moves in real time. You're trading probability shifts, not time decay. This also means you can use Kalshi proactively, not just reactively. You can open positions weeks before the event when odds are mispriced, or you can close them early once the market catches up. And that's an important nuance. You don't have to hold until settlement. If you buy a yes contract at 40 cents and it jumps to 70 cents before the event happens, you can sell early, lock in profit, and move on, just like stocks or crypto. These contracts are tradable on an open order book. Alright, so when most people think about diversification, they think about spreading across sectors. Some tech, some healthcare, some energy, maybe a little crypto on the side, but that's only surface level diversification. It's still all directional. Everything rises or falls together when macro risks hit. True diversification, the kind institutions care about, happens across risk factors, not just assets. You want part of your portfolio exposed to information risk, not just price risk. And that's where Kalshi comes in. So let's say you got a 10,000 portfolio and you have 5,000 in stocks, 2,000 in crypto, and 3,000 sitting in cash. Well, right now, 100% of the portfolio is correlated to risk on behavior. If the Fed surprises the market or inflation spikes, all of it can take a hit at once. Now imagine you reallocate some of that to event-based hedges. Like, will CPI be above 3.5% yes contracts? Or will the Fed cut rates this quarter no contracts? Or will unemployment rise above 4.5% yes contracts? Or will oil close above $90 yes contracts? What you've just done is build a mini macro insurance fund inside your portfolio. The economy heats up, your CPI and oil contracts pay off. The Fed gets hawkish, your no rate cuts contracts gain value. If the job market weakens, unemployment contracts cover the downside. Each one of those positions acts like an airbag. When the market hits turbulence, they inflate and cushion the impact. So you're not trying to predict every move, you're preparing for any move. And that's what we mean by building balance through event risk. Even allocating 5 to 10% of your portfolio this way can dramatically change your drawdown profile. Instead of dropping 20% during a macro panic, maybe you drop 10% because your event hedges offset the shock. This is also how professionals design volatility-controlled portfolios. They don't just own assets that go up, they own exposures that protects when things go down. Kalshi contracts give retail traders a way to replicate that institutional approach without needing derivatives licenses or complex option strategies. Now I know some of you are thinking, okay, but how do I decide which event to hedge? Well, the answer depends on your portfolio sensitivity. If you're heavy in growth stocks, you can hedge inflation and rate hikes. If you're in energy, you can hedge oil price drops or global slowdown. If you're in crypto, you can hedge CPI or regulation or dollar strength events. And if you're in the broad market, you can hedge unemployment and GDP shocks. You're essentially mapping your vulnerabilities and buying protection in the data that could trigger them. That's smart diversification, which is key. Here's another way to think about it. When you buy a stock, you're saying, I believe this company will do well. When you buy a Kalshi contract, you're saying, I believe this situation will play out. Those are two completely different dimensions of conviction. One is micro and one is macro. Together, they make you more complete as a trader. Let's also touch on timing and structure. A balanced portfolio doesn't mean you're always hedged. It means you're strategically hedged. During calm periods, you can hold fewer event contracts. During volatile cycles, like earnings season, election year, Fed tightening, you can scale up your macro hedges. Another advanced trick is to use profits from events contracts to fund your long-term investments. Let's say your inflation hedges pay out $800 during a volatile quarter. Well, instead of withdrawing it, you can reinvest those gains into high-conviction assets while they're discounted. You've effectively turned volatility into opportunity. And over time, that habit compounds too, because you're not just surviving the drawdowns, you're monetizing them. The key takeaway here is that a balanced portfolio isn't just stocks and crypto, it's stocks, crypto, and data exposure. You're turning information itself into an asset class. Stocks trade the output of the economy, crypto trades the innovation of the economy, and Kalshi trades the uncertainty of the economy. Owning exposure to all three means you're protected from every part of the cycle: growth, contraction, and confusion. That's what modern diversification looks like now. So now that you understand how to use Kalshi to hedge individual positions and how to build balance into your portfolio through event exposure, let's step into the final level: pair trades and correlation plays. This is where you start to think like a macro strategist instead of a retail trader. Because at this level, it's not about being right on one specific outcome, it's about understanding the relationship between outcomes. A pair trade on Kalshi simply means taking opposing positions in related markets. One long, one short, or one yes, one no, to trade the relationship rather than the direction. You're You're no longer betting on what will happen, but on which outcome is more likely given another. So for example, you're watching two active markets. Will the Fed hold rates at the next meeting, and will CPI for the next month come in above 3.5%? Historically, those two data points move in opposite directions. Higher inflation data usually increases the odds of a rate hike, while cooling CPI decreases it. But sometimes those probabilities drift apart. Maybe CPI odds are rising, but the Fed holds contracts hasn't caught up yet. That's a spread opportunity. You can go yes on CPI above 3.5% and no on Fed holds rates. If inflation runs hot, your CPI contract pays off while the odds of a Fed hold drop, giving your profit on both sides. If inflation stays low, your CPI side loses, but your Fed holds no contract gains value because the Fed is less likely to hike. Either way, you're trading the relationship, not the direction, and that's the essence of correlation trading. Suppose you believe the economy is weakening, you expect unemployment to rise, but you also think the Fed will still hold off on cuts longer than people expect. You can structure that as yes contracts for unemployment rises above 4.5% and no contracts for the rate cut before March. The setup expresses a nuanced view, economic weakness without immediate stimulus. You're not betting on catastrophe, you're betting that reality unfolds slower than the market expects. This is where Kalshi becomes a playground for macro logic. Every contract represents a piece of a bigger picture. Inflation, rates, jobs, oil, GDP, elections. You can connect those pieces like a strategist and trade the relationships between them. So yes contracts on oil above 80 and no contracts on CPI under 3% is a play on energy inflation. Yes contracts on employment under 4% and no contracts on the rate cut before June can be a strong economy thesis. Yes for Bitcoin above $100,000, but no for Fed hikes this meeting could be a liquidity correlation play. Each one of these pairings mirrors how institutional desks think. They don't bet on absolutes, they bet on probabilities converging or diverging. What's powerful about this approach is that it naturally limits your risk. You're not exposed to broad directional swings, you're trading the spread between two ideas. If you're right about the relationship, you can profit even if the market as a whole goes nowhere. It's also a great way to stay emotionally balanced as a trader because you're not stuck hoping for one perfect outcome, you're observing relationships evolve in real time. It keeps you analytical instead of reactive. So imagine you're looking at Kalshi's dashboard and you see two markets side by side. Will the Fed cut rates by March, trading at 60 cents, and will CPI fall below 3%, trading at 35 cents? That pricing suggests the market expects cuts before inflation hits target levels, which historically doesn't happen. You might take the other side, yes, CPI falling and no early rate cuts. That means if inflation cools faster, both legs can pay out. If inflation stays sticky, the early cut market drops faster and you can still profit. This kind of reasoning is where you start to see the structure of information itself. You're no longer watching news as a random chaos, you're tracking how probabilities adjust to it. That's what makes pair trading so satisfying. It's a puzzle, but one where your conviction has mathematical edges. For intermediate and advanced traders, Kalshi pair trades are a gateway into quantitative thinking, into seeing trading as a game of scenario design instead of prediction. So at the end of the day, it's not about being first, it's about being prepared. Every time there's a CPI release or a rate decision, an unemployment print, a major policy speech, you're going to see chaos on social media. You'll see panic, opium, and confusion. But if you've done your homework, you understand the relationship between these events, then you'll already be positioned. That's what we mean by staying ahead of the markets with education. This is why we built the Crypto Safety School. It's not just about crypto wallets and scams, it's about giving traders the full toolkit to survive in a world where data moves faster than price. Whether it's DeFi, regulation, tokenization, or prediction markets like Kalshi, the goal is the same, to make sure you're not the last one to understand the rules of the new game. Here's the truth that most people won't tell you. Financial markets are converging. Crypto, equities, and prediction markets are not separate ecosystems. They're three sides of the same coin. Crypto lets you trade innovation, stocks let you trade ownership, and Kalshi lets you trade information. And the traders who learn to connect those three will own the next decade. And that's where Pennybois and our education system comes in. We're building the bridge between all three worlds: psychology, strategy, and technology. And Kalshi is a perfect example of that evolution in action. The future of trading belongs to those who understand how stories become probabilities. Because once you learn to trade the story before the chart tells it, you'll never look at markets the same way again.